right, let's go ahead and get started. We are at the top of the hour and want to make sure that we respect everyone's time that is joining with us today. So again, thank you very much. Just wanted to bring everyone some updates as to what we know and kind of what we don't know about the Secure Act 2.0. I definitely brought in a lot of good things in my opinion, but there are some things that are still yet to kind of be decided and some interesting unknowns. So we'll make sure we cover exactly what the Secure Act 2.0 is and what it's done for us so far and kind of what people might need to know, what we need to know in order to kind of make informed decisions when it comes to doing tax strategies towards the end of the year. So again, we're going to be covering the Secure Act today. Just a little bit of disclaimer information before we get started. A little bit about me. My name is Alex Perny. I've been with Advanta IRA since 2012. So coming into my 11th year of doing this, I've had a lot of experience in navigating through several different administrations of tax law changes and how this applies to IRAs and how people can best navigate these things. So if you want any questions answered, feel free to let me know. You can either reach out to me directly with a phone call or an email. And if you'd like a copy of the slides, just email me since I was having trouble with attaching them, and I will certainly be happy to email them to you afterwards. Since we are going to be covering a lot of things that are tax related, we just need to make sure that we kind of disclaim what we do and don't do. Advanta IRA and our employees do not provide investment advice or endorse or promote any products, nor do we give tax or legal advice. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment, or more specifically to this presentation, making any decisions that might have a taxable implication for you. Okay, some key points to take away. So there have been some IRA RMD changes and changes to contribution amounts. We're also going to kind of cover what we do know and what we don't know about how to actually make some of these new contribution changes, especially as it relates to some of the new Roth opportunities and some of the 401k plan changes that we're just not necessarily sure on how they're going to play out, because the way this works with legislative changes, while Congress and the government might write new legislative changes into effect, it's up to the IRS to actually implement those changes. And unfortunately, the IRS being, what they are, they haven't necessarily gone full tilt with getting a lot of these things enacted and giving us guidance as to how to actually implement them for our clients and, for you as taxpayers or maybe small business owners, how to take advantage of some of these things. So again, we'll cover, what has changed, and we'll also specifically cover what we don't necessarily know as far as the updates that we're going to be covering today. So here are some of the RMD and contribution changes that we're looking at. Right now, RMD payments begin at 73, and that is going to be for any pre-tax account. So that is going to be for your SEP IRAs, your simple IRAs, your solo 401ks. The one that has not changed for distribution timelines is going to be HSAs, but they don't have a required minimum distribution anyway. But just know that that is one of the things that actually is in effect. So the IRS did give guidance. We do know now that if you turn 73 this year, you do have an RMD, but if you didn't turn 73 yet or you're 72, you have an extra year to do that. Penalties for failing to take a required minimum distribution have been reduced. This is one thing that I think is a very big benefit to a lot of people. So this is, again, in effect. Essentially, what happened in years past is that if you failed to take a required minimum distribution, you had to pay half of the required minimum distribution amount in a penalty, which is absolutely wild in my personal opinion. And this directly affected the lower income earners, the people that actually needed their required minimum distributions significantly more than other people. For example, if you had a $100,000 distribution that was required from a pre-tax retirement plan, it's much easier for someone that had to take out $100,000 from an account to pay $50,000 than someone that had a, let's say, $1,000 RMD to pay $500. That's the direct difference of them being able to afford gas to go pick up medicine or go to a doctor's visit. So that's a very big change. It is in effect. I'm very happy with what has happened. Essentially, what has happened now with the required minimum distribution penalty change is that if you fail to take a required minimum distribution, the penalty is now 25% down from 50, which is still very high. Again, still a very high penalty, but they included an additional provision is that if you self-report on your income tax statement, then it will only be a 10% penalty. Now, of course, going down to 25% is easy enough, but again, with the IRS and what they haven't told us, they haven't exactly told us how to self-report that. Hopefully in the last quarter of this year, we will get some guidance on that, because being able to take a required minimum distribution penalty from 25% down to 10% with a self-reporting clause on your personal income tax statement is a significant reduction. Now, everyone should be taking their required minimum distributions, but just like with everything, life happens, especially with people that don't, pay as close attention to their finances or just didn't realize that something had to happen. It's easy enough not to take money out of an account like that. It's, ingrained in me. I'm a financial professional. I know that. But for most people, they may not realize that they have to do it, or they get an account statement, they just don't realize. So again, we don't necessarily know how the self-reporting function is going to work for the reduction in the self-reporting penalty, the self-reporting penalty reduction for required minimum distributions. But at face value, the total, like if you didn't self-report and you had a penalty to pay, it has gone from 50 to 25%. Now, some things that we're going to cover additionally with what we do and don't know. Roth 401k plans now have the same required minimum distribution rules as a Roth IRA, insofar as that they don't have one. That was always kind of a screwy rule that I never understood why, but Roth IRAs and any of your after-tax retirement plans, I should say the Roth IRA did not have a required minimum distribution, but the Roth 401k did. Now those rules are more in alignment. So if you have a Roth 401k, you don't have to worry about trying to roll over those funds out of the 401k into a Roth IRA. There are some inherent investment advantages for certain types of investment structures that would predicate you wanting to leave money in a Roth 401k for as long as possible. But now that you don't have the required minimum distribution factor on the Roth portion of a 401k, again, it kind of brings everything into alignment with some uniformity in the rules, which is good. Nothing's really changed too much. I believe that the cost of living or COLA adjustments for IRA contribution limits are going to be relatively easy enough. It's not the most important thing to kind of take away from this, but it's important to know that the increases to contribution limits are going to be a little bit more on a regular schedule, and they're going to be based on a metric of cost of living in $100 increments. So while it's nice in years past to see them kind of nice round figures of like 500, 1,000, granted they don't come often enough for most people, but we're going to start seeing those come at a little bit of a higher clip. It's easy enough for them to factor that in. So I would imagine that coming into next year, we'll see some cost of living adjustments, maybe in some odd amounts for your IRAs, so your Roth and traditional, your elective deferral into a 401k as well. And then we have some pretty big changes to catch-up contributions. So presently, for a contribution going into a traditional or Roth IRA, once you reach the age of 50 and a half, you get an additional, you get an additional $1,000 kicker you can put in there. That's going to be changing in 2025 to some fairly significant amounts, and we'll get into that in a minute. But also catch-up contributions that we're waiting on some guidance for as well. And we'll just change slides so we can kind of see it enumerated a little bit better. Okay, so right here we have the current contribution limits for retirement plans. The other one I want to draw your attention to before we go through everything else is that presently, or in years past, with family HSA plans, you were allowed a single $1,000 catch-up contribution. If you have a non-dependent family member, so think married spouse, you are now able to, in theory, make an additional $1,000 catch-up contribution to a family plan if you have two taxpayers in the household filing a joint income tax return. Again, we don't necessarily know how that's going to play out with coding, because if you're filing that, typically it's going to be a metric of $1,000. If there's going to be an additional code, or if they're just going to bump it up to $2,000 in total for a married household if you are over the age of 50 and a half, we don't know yet. Again, IRS reporting is kind of the key to a lot of this. So while we may certainly have some of these great things that are being written into existence, that is one thing that we're, again, not sure of on how exactly that's going to work. So presently for traditional and Roth IRAs, you can kick in $6,500 if you're under the age of 50 and a half, or $7,500 if you're over the age of 50 and a half. Presently with SEP IRAs, and again, we'll get into some of the additional Roth options on a different slide. Last year, you could kick in 25% of your compensation up to $61,000. So if you haven't filed your taxes yet, and you are a sole proprietor, sub S, single member LLC, something like that, you can still set up a SEP plan and defer compensation for last year to the tune of 25% or $61,000. And you can also include into that your traditional Roth IRA, your traditional IRA contribution to that as well. So it brings you up to the high 60s and low 70s for total contribution amounts to a SEP IRA. But keep in mind that the traditional component couldn't be made for last year as far as the IRA goes. You could just do the salary deferral before you file your taxes in mid-October if you are a self-employed individual. Simple IRAs, I don't like to spend too much time on them because I find that they are a horrible acronym for a very complicated plan to administer. So just be aware that there have been some changes to simple IRAs. If you're someone that uses one, fantastic. I can go into that more detail maybe on a one-on-one basis. Solo 401ks, we had a nice bump in the amount of deferral of compensation you can do for this year. So this year you could kick in $22,500. So we got an additional $2,000 on the front end and an additional $1,000 catch-up contribution kicker if you're over the age of 50. So now with a solo 401k for this year, you can defer quite a bit of compensation just on your elective deferral portion of it. And then you can also contribute up to 25% as the non-elective up to a match of $58,000 or $66,000 of total planned contribution to that plan. ESAs haven't changed, and health savings accounts, again, with that additional provision for the potential to have dual $1,000 catch-ups if the family as a whole, the joint tax filing household is above the age of 50 and a half, we have the potential for $2,000 catch-ups if you are covered by a family high deductible healthcare plan and have qualifying HSA coverage. I know that's a lot to kind of take in, but again, some of this stuff is a little bit more complicated than others. And keep in mind, if you do have questions, please do fire those into the question box. I will be happy to address those as they come up. Again, don't necessarily need to wait till the end of this. I am happy to address them as they crop up. So keep those questions coming if you do have any. All right, let's get into some of the good stuff and maybe some of the bad stuff, which I've highlighted in red because we don't know how it's going to actually play out. So again, this year, annual contributions have gone up to $6,500 and $7,500. It doesn't really have much of a bearing for previous year contributions at this point, but just understand that that is what your 2023 contributions are now pegged at. Now, beginning in 2025, we have some really cool stuff coming into effect. Again, we have a few years before this comes into effect. Well, a year and 2 months, which is wild to think about. But beginning in 2025, individuals aged 60 to 63 will be allowed to contribute an additional $10,000 per year per individual. So that means if you're a household that is, let's say both you and your spouse are 60 in the year of 2025, you can make an additional $20,000 per year of annual contributions to an IRA. So that's a total of $60,000 of additional IRA contributions that you can make in a 3-year runoff. And the really cool part about that is that there's no phase out for having too much income. So let's say you are an individual that makes over the amount that can contribute to a Roth IRA. Well, if you make over $145,000 per year, you will have to make that into a Roth IRA. You'll have to make that after tax. So it's nice that they've actually looked at this and said, hey, we don't want to, exclude some people, again, with what making $100,000 meant now versus 10 years ago. It's definitely nice that they've kind of come around to the thought that, hey, allowing people to add money in while we are able to collect more taxes and not give additional tax breaks was always kind of my opinion of what the more appropriate measure would be, and they've taken that into consideration. So again, if you're making over 145K a year, the mega catch up for people starting in 2025 will have to be made after tax. And that's not including your annual contributions. So, do the math there. There's a considerable amount of money that you can get into retirement plans starting in 2025. And again, we don't have any type of guidance from the IRS yet on how exactly you're going to report that, but we're giving them plenty of time to get that one written into effect. But again, that's definitely something to keep your eye on the horizon for maybe trying to save a little bit more. If you know that you're able to contribute a little bit more in a few given years, it might play into some tax strategy that you have right now. So again, talking to your tax strategy expert, your tax advisor, your CPA, your spouse, whomever, and kind of understanding how much more money you're going to be able to get into these plans at a future date. Granted, it's only going to be 14 more months until this kind of stuff goes into effect. Definitely something to look at. So the potential for the HSA plans will allow the additional $1,000 catch up. We just don't have guidance on yet. So, kind of wait and hear. We'll put out some additional tax law updates, but just keep that in the back of your mind if you are someone, that utilizes high deductible healthcare plans and family HSAs, that you might want to keep a weather eye on some tax updates for additional money you can contribute in there. Now, current guidance from the IRS, and we haven't gotten a definitive answer on this, is that individuals making over $145,000 per year will now need to start making their elective deferrals, so that $22,500 or that additional $7,500 kicker, the catch-up contribution, might need to start being made into the plan after tax. So you might have to start making those as a Roth contribution to the plan. The idea being is that high wage earners getting additional tax breaks are reducing the amount of income that the IRS is going to generate in a given year. So the potential for that to be changing is pretty, I would say, probably most likely going to happen. We just don't have guidance on that yet. So if you are kind of starting to do tax planning for next year, or you are going to try to make your 401k contributions in this year as far as your elective deferrals, looking at how much money you make and as it relates to how you are going to be claiming deductions is important, because that's something that, again, we need guidance on, and we'll put out some additional updates on how the front end or the elective deferral of the compensation into a 401k plan is going to look like for an individual. Now, here's some really awesome stuff, but also some really unfortunate things from the IRS is that they've basically created a lot of new Roth IRA opportunities within this tax legislation, which, one, I think is very good, but two, again, in IRS fashion, we don't exactly know how this is going to work out. And I'll kind of guide you on exactly what we're looking at, is that previously all employer contributions to SEP and simple IRAs, as well as the elective deferral, the non-elective, so the employer match portion to a 401k, had to all be made pre-tax. Now you could do conversions, so you could convert that into a Roth IRA immediately and just claim the additional income, but now we're given the opportunity to make after-tax contributions to these plans. Now, what we're waiting on guidance from is that since a SEP IRA contribution is made as a business contribution, how exactly, if you're making an after-tax business contribution to the plan, would that effectively be shown on the business return? Now, for individuals that are filing as, let's say, maybe a sole proprietor or filing as a sub S, that might not necessarily be as big of a deal because you're just going to show additional income. But if you're filing as a C Corp or you're filing as a multi-member partnership, there definitely is some unknowns with how exactly you're going to report that being made as an after-tax contribution to a SEP or a simple IRA, or again, importantly with the solo 401k, how making it that contribution as after tax is going to affect everything. We don't have reporting codes yet. Now, with SEP IRAs and simple IRAs, we have worked it out with our software developers, at least here at Advanta, to be able to accept after-tax contributions into these plans. So if you have a SEP IRA with Advanta and you want to make a after-tax contribution to that plan, so you defer your income into the plan, previously, you would just claim that as a deduction. Now we are able to code it as a Roth SEP contribution, but we have yet to receive guidance from the IRS on how we are going to turn around and report that on what's called IRS Form 5498, which is the reporting form that we use to send to the IRS that says, hey, John Smith has a SEP IRA with Advanta. They made X contributions, and then you used to be able to turn around and say, yes, I'm writing this off on my shown income for the given year. X, Y, and Z, you get that all buttoned up. So presently, we don't know how to report that to the IRS. We can accept in the contributions, but just be aware that especially if you are someone that wants to take advantage of after-tax SEP contributions, this year is still a lot unknown. And with the fact that we are halfway through September, turning the corner into the last quarter of the year, going with these unknowns and maybe going the route of doing it pre-tax and then doing a Roth conversion, again, things to talk to your tax advisor about. But again, I just want to let people know what we don't know yet as far as the updates, because nothing really has fundamentally been brought to our attention from the IRS as far as changes to the actual bill itself or what was written into legislation. Mainly what I want people to take from this presentation today is just the kind of lack of guidance we've received from the IRS as to how some of this stuff is going to work. Because on face value, saying, hey, you have a SEP Roth now, you have a simple Roth now, you can make solo 401k non-elective contributions, so the employer match to that after tax now. That all sounds great on paper, but until we functionally know how it's going to work, again, maybe having a little bit of pause when it comes to really changing direction might be prudent in this case. But again, the ease of use for this is going to probably be pretty nice once we actually get it fleshed out with the IRS, because now instead of having to do something like a SEP contribution and an immediate Roth conversion, if you want to be investing after tax, you can just do this all into the same plan. There's not going to be needs. There's not going to be a perceived need to have multiple different accounts to accommodate your pre and post tax contributions. And also, what are the accounting principles that are going to be used if you want to do a commingled pre and post tax SEP IRA or a simple IRA? We have a good amount of guidance on how that works with 401ks, because you've been able to utilize Roth 401ks for quite a long time. So how is the accounting going to work? Will we have to segregate those funds? Will you be able to commingle everything and invest in a more omnibus fashion and just treat your net earnings attributable to the underlying pre and post tax basis? I know that's a lot of kind of higher level accounting talk, but the simple fact is that, again, we're just not sure how the IRS is going to want us to administer these accounts, and whether or not we're going to need to maintain separate accounts like we do for traditional and Roth IRAs with that same principle with SEP and simple IRAs, or if we're going to be able to combine them and allow clients to invest their pre and post tax monies under the same account with a SEP and simple IRA. So back to the thing I keep harping on is that we just don't know a lot of this stuff. So making your decisions on how to actually go forward with this, maybe wait a little bit longer and figuring that out, or just kind of go on the same principles of doing Roth conversions if you want to utilize after tax investment strategies. To finish off this slide, unused 529 plans can be rolled into a Roth IRA now if the plan is over 15 years old. So that's a really big benefit, especially with the more of the population seeing the benefit to alternatives to going to a traditional four-year college. 529 plans have started to remain stagnant at a greater clip. So now being able to roll those funds into a Roth IRA is, again, I think a very big benefit that people are going to see a lot of use for, because previously it was kind of a use it or lose it. You would get a tax benefit for contributing, but then might have to take it as a distribution and then repay those tax benefits. So being able to have a mechanism where you can just dump the funds into a Roth IRA if they've remained unused for 15 years, I think is a pretty big benefit. Ooh. Sorry, skipping around a little bit. So some 401k changes. So we now have an automatic enrollment for all eligible participants starting at a 3% contribution per year. That means that individuals that set up a 401k plan, if you have qualifying employees, you will have to automatically enroll them at 3%. They are able to opt out, and it can be a max of 10%, meaning what the employee is already contributing in out of their elected deferral, their compensation to the plan. We're now going to see these plans change if you have qualifying rank and file employees, meaning if you have a 401k plan for a business and you're not a solo 401k plan, so a business that has an individual working over 1,000 hours per year or over 500 hours per year over a 3-year testing period, you would need to start doing automatic enrollment for them. Again, the Department of Labor and the IRS have not given guidance on exactly what type of notifications have to be given to employees for that, but it is written into law. So, it's something to definitely keep an eye on, is that we have not received guidance on exactly what that would look like for, the small business owner, not the self-employed individual. Because for solo 401k owners, some of those provisions are not there. So especially for solo 401k holders, if it's just a self-employed business, owner-operated business, the need to provide plan updates is significantly reduced than if you do have more of a safe harbor plan or something that has to have plan discrimination testing. Again, 401k plans do not have RMDs, so that has gone into effect. We know that for for this year. So if you had a Roth 401k, you don't have to take that RMD this year. You can just leave it in the plan. And especially for those of you that want to invest in things like debt leveraged real estate, being able to keep the funds within a 401k. For those of you that are doing debt leveraged real estate, commercial real estate investments for solo 401ks. Definitely a good thing to happen for all of y'all. Now, to this point again, and again, I like to make sure that we're covering this as effectively as possible. To go back, I lost my train of thought. So now sole proprietors and single member LLC 401k plans can now make elective deferrals. So that means that deferring your compensation can be done up until your tax filing deadline for the previous year. So before, to kind of explain what that means, is that if you wanted to establish a solo 401k plan before your tax filing deadline, you could do that. In years past, you used to have to establish them before year's end to make a previous year contribution. The first Secure Act got away with that and said, hey, if you establish it before your tax filing deadline, you can make the non-elective or the business match up until your tax filing date plus extensions. But now, so long as that the plan is established in a given year, so let's say we're going to use this year's extended filing deadline as an example. If you had established a solo 401k by 12/31 of last year, and you had not made your $22,500 or your $7,500 additional kicker, so your compensation deferral to that plan, you are now able to make that up until your extended filing deadline plus extension, or sorry, your filing deadline plus extensions, which is again very beneficial because a lot of self-employed individuals don't exactly know how much money they made until they file their taxes. So you really don't know, again, how much money you make until you file those. So being able to bring that into alignment with your non-elective or your business match is very important. So if you establish the plan by 12/31 of last year, you now have until your filing date plus extensions to make all the contributions to a solo 401k plan. You just have to make sure it's established by 12/31 of that year. Oh, someone asked a good question. Sorry if it was that was not accurately addressed. So what is an RMD? RMD stands for required minimum distribution. That is when you have pre-tax plans, you are required to take out a certain amount of money of those plans, and previously solo 401ks did as well. But essentially, you had to take out a certain amount of money as it related to 1, your marital status, 2, the account value, and 3, your life expectancy as determined by the IRS. They have a big, huge, like spreadsheet tables that you plug in the account value, your age, and your marital status, and it tells you how much money you would have to take out of a specific account on a given year. So that's what a required minimum distribution is. Sorry if that missed the mark on anyone, but hopefully that clears that question up. Now, again, with the solo 401ks, just like with what we don't know about SEP IRAs, is that the employer match, so that 25% of your net operating income that you can contribute into a 401k plan on an annual basis, you can now make that, in theory, that can be made after tax. So you can do all of the contributions into a solo 401k plan after tax. However, we don't have the IRS reporting guidelines for you as the small business owner on how you would necessarily report that being made as an after-tax contribution. So again, while you now are under no obligation to have to do the contribution after tax and then do an in-plan conversion for specifically a solo 401k, we don't exactly know how you're going to report that to the IRS that you made a after-tax contribution. The codes just don't exist yet for you to plug in on your business return to say, hey, I made an after-tax employer contribution to the plan. The employee contribution has already been well established. I got another good question here. Let's see. So what was the original thinking about Roth 401ks having RMDs since the money was tax-free anyway? That is a great question, and that implies that I would know what the thought process behind the Department of Labor and the IRS is. Honestly, I think it was just something that was more of kind of like a clerical oversight. Just when they're doing tax law updates, it's just something that just never got around to it. They said 401ks have a required minimum distribution and they just went with it. And because you can do after-tax 401k plans, that was written in, the Roth 401k plan was written into existence in, I believe, 2005, and the Roth IRA was written into existence in 1998. So there was a gap in kind of the legislative creation of both of these types of accounts. Now, when they went and made after-tax contributions available to 401ks, I'd imagine it was just kind of a, more or less kind of a legislative copy and paste, if you will. They said, hey, 401ks have required minimum distributions, you can do Roths now, and it was just never looked at. Why it took so long to change, especially when we had, going from 2005, we have a lot of different, legislative political leanings coming into effect. We had several different administrations come in. So I am very surprised that it took that long to come into, uh, alignment with Roth IRAs. But again, that's that's one of those things where we can only speculate. But again, at least moving forward, now that we don't have the required minimum distribution for the Roth 401ks, it makes things simpler for people. And I think any time that the IRS or the Department of Labor, by extension with 401k plans, can make things easier on people, the better. But of course, now we've had this legislative, this block of legislation that was written into effect, mainly going into effect January 1 of this year, almost being in October, and we still don't have reporting codes. It makes me a little bit nervous about, the fact that they're, they may be overpromised with what the IRS can actually deliver on the functionality of doing this stuff. Granted, I'm sure it will all get worked out eventually, but for being able to take advantage of some of this stuff this year, it's kind of a little bit of a letdown. But hopefully the IRS can get us the codes we need, get people the guidance they need, because again, it can be written into existence, but until we have guidance from the IRS on how to effectuate these changes, they might have not even been written into existence. So that's kind of what we're looking at now. Again, waiting on the employer side guidance for how to make those after tax. But again, the function of being able to make your entire 401k after tax is still there. You could do an in-plan Roth conversion. So you could contribute all of the money into the 401k plan, separating out your elective deferral, so what you contribute in out of your compensation, and then the employer match. You already can do an immediate conversion of those funds. Granted, you would have to claim that as additional personal income. So maybe there's some tax planning strategies, which again, I am by no means a tax planning strategy expert, of being able to claim additional income corporately. If you're able to write off more of your revenues corporately and making that after-tax contribution, again, there might be some very good benefit there. But again, we need guidance from the IRS on how that's going to play out, and what exactly benefits are going to be derived from that remains to be seen. So kind of bring this in for a little bit of a landing, some other things that I want to make sure that we kind of cover on this. Single member LLCs and sole proprietors have the flexibility on making elective deferrals to their solo 401k. Again, if your plan is established by 12/31 of the previous year, both buckets of contributions can be made into the plan by your extended filing deadline. Previously, it was a little bit of an unknown as to when you needed to make your elective deferral, so that front-end contribution. Best practice was that you made it by 12/31 of the following year, as payrolls typically aren't run, later on in the year for services rendered. But again, with sole proprietors, self-employed individuals, these kind of people just don't know how much money they made, whether it was personal revenue or business revenue, until they file their taxes. It's individual people are not filing as C Corp, so they just don't know that. So very good benefit to individuals there. One thing that I really like, and this is, again, not necessarily for the fact of the sole proprietors, because again, we don't know how this is going to play out, but especially for younger individuals that maybe want to be self-employed or full-time investors, if you have qualifying if you have qualifying student loans previously, and to use an example of myself, I didn't participate in Advanta's 401k for the first maybe 3 or 4 years of my employment, because I thought the money would be better used in paying off my student loans. Thankfully, I was in a position to where that played out for me. My wife and I were able to pay off our student loans, but we made the decision to not participate in our 401k plans, to allocate that money elsewhere. But the downside to that is that we missed out on the employer match, that free money to the 401k plan, because you have to contribute in to receive a match of 3, 4, 5, whatever the percentage match is from the employer. Now, and again, we're waiting on the Department of Labor to give guidance on how you're going to notify participants of this. And again, it's not necessarily so much to the self-employed individuals, but you are now able to treat your student loan repayments up to a tune of, I believe, $600 per month as participation in the plan. So if the plan is matching contributions at 3%, then you would be able to receive that free money into the 401k plan, because you are making those student loan payments. So you're not having to put money into the 401k plan and also pay the student loans. You're allowed to pay the student loans, treat that as your participation in the plan, as if you were actively participating, which I think is a fantastic benefit that's being offered because, again, trying to reduce the reliance on Social Security, trying to make people more self-reliant, trying to increase individuals' own retirement plan savings is, I think, going to be a net positive, and allowing people to pay off student loans, which I'm very thankful that I graduated when I did, but again, they can be very onerous and hard to effectively budget with. So good thing there, not necessarily to the point of the self-employed individuals. It might be if you have student loans and you want to, treat part of your contribution as a student loan repayment and then factoring in your employer match. It's going to be really specific because you might need to file as a C Corp for that to come into effect for a solo 401k. And most people that are self-employed are going to be filing as a sub S, a single member LLC, sole proprietor, that kind of thing. So although maybe not necessarily specific to the people on this call, important to understand. You're also now able to self-certify hardship withdrawals from 401k plans, which again is a very good thing. Previously, you used to have to notify your employer of your hardship. So that's, again, very good on the broader spectrum of things to understand with this, is that you can self-certify those hardships, whether that's medical or anything else. If you need to take a hardship withdrawal from a 401k plan, you can do that without having to notify your employer of specifically what that hardship was. And that was a carryover from the CARES Act, which was the large block of COVID relief legislation. So again, net positive, good thing. And then we also are going to have a creation of a lost and found network to help taxpayers find old employer plans that are no longer in business. It's going to kind of be a wait and see to how that actually plays out, but again, if you are struggling to find old 401ks or old retirement plans, there is going to be a network built. And of course, we're going to have to rely on the IRS to build something that is functional and usable. Take that for what it's worth. That again, there should be a network coming online in the next few years that'll help individuals find old retirement plan funds from previously shuttered employers, or if you just can't, determine who the administrator of that plan is through mergers, acquisitions, that kind of thing. There will be an effective way to find those retirement plans. So with that said, that's kind of what we have as far as the tax law, the updates of what we do know and what we don't know about this big block of legislation. Again, didn't quite take up the full hour, but there really wasn't much to say besides the fact that there's definitely some stuff we don't know, mainly centering around how exactly the contributions to previously only pre-tax plans are going to be reported. So think SEP IRAs. How do you make an after-tax SEP IRA contribution? Can those be commingled? Again, we'll do another one of these updates towards the end of the year once we have some more guidance from the IRS. But what I want people to take away from here today is that if you were planning on utilizing some of these things, again, maybe waiting a little bit and going in accordance with your already established tax planning strategies might be a good move. Again, absolutely check with your tax advisors, people that can advise you on the best way to do this. But since we have such little guidance on some of these things from the IRS, utilizing some of these strategies this year, how do we do it? We don't know. But again, we can certainly take in SEP IRA contributions and as an after tax, but we just don't know how to report them yet. So with that said, I'll stick around if there's any questions for people. If there's something you'd like me to give you a little bit more guidance on, happy to do so. But I do thank everyone for taking time out of their days today to be with us. We always appreciate your attendance and joining these things, and I do enjoy putting them on and helping to educate people. So I'll stick around for a little while to answer questions. Again, thanks for being with us and have a great day.